Okay, our first learning objective here, it's a long one. We got a lot to do here. Describe the foreign exchange market, including its functions and participants. And this actually comes later in the learning objective. It's sort of at the end. Distinguish between nominal and real exchange rates. Calculate and interpret the percentage change in a currency relative to another currency. All right, we're beginning the reading on currency exchange rates. And currencies can be a little bit tricky. So I'm going to go slow over the first few screens just to make sure that you have the terminology right and the notation right, because if you don't get that, you can get lost very quickly trying to figure out, hang on a second, what's changing? Which one's going up? Which one's going down? So let's have a look at what we have in the top corner here. We have a bunch of three-letter tickers. If they were stocks, you would think, well, what stocks are these, right? All currencies have three letters and can be denoted by three letters. The US dollar, the euro, the pound, the yen, the Canadian, the Australian dollar, New Zealand, Norwegian krona, the Swedish krona, Swiss franc, the ruble, the Singapore dollar, and there are many others. So that denotes a specific currency. When we talk about exchange rates, it has to be two, because if you're talking about the Canadian exchange rate, well, with what other currency? What you can exchange Canadian for US dollars, for pounds, for euros, for yen, for pesos? Which one? So exchange rates are quoted in pairs. And that's what can make it tricky sometimes, because if we quote the US dollar in terms of euro, it's not the same as quoting euros in terms of US dollars. It's a different rate. There's a relationship, but it's different. So the order of the pair matters. So let's just break one of these down first. We'll learn how to read one of these quotes, and then we'll go to the notation used in the book, which is just a ratio. But first, if we can read this, it'll make this a lot easier to make sense of. How these are read is the first of the pair is always 1. So 1 euro buys this much US. Another way to say it is to get a euro. If you have US dollars, you need to pay 109.50 US to get 1 euro. If you have 1 euro, 1 euro will get you 1.095 US. This is called the base. This first one here is called the base. In fact, that's the base right there. That's the base. That's the base. The first of the pair is the base. The second of the pair is the price, currency. So let's see if we can't read this one. This is easy. 1 US dollar buys 1.3925 Canadian. Or you need 1.3925 Canadian to buy 1 US dollar. That's nice and simple, right? If they're expressed in terms of a ratio A to B, a little bit different. The base makes sense. The base is where? In the basement, right? It's in the denominator. Just think about it that way. Base is the first part of basement. The basement is down here. So the base, the euro, here it's euro.us. This would be US over euro. So you wouldn't think, well, it's euro over US because euro's first. This comes to the bottom. That goes to the top. So the price currency is on the top. The base is on the bottom. And it makes sense, right? How else do we get, in a ratio, how else do we get 1.0950? If the base is always 1, then the numerator is 1.0950, right? So 1 euro buys this much US. The base buys this much. That's the price of the numerator. So in this one here, here's the base. It's a US dollar. Here's the numerator, Canadian. That's the price of the numerator. 1 US dollar buys 1.3925 Canadian. Or to say it another way, for Canadian, we need 1.3925 Canadian to get 1 US dollar. The base, the price. So let's see if we can't figure out the movement now. Stocks are easy. If you buy stock at $20 and it goes to $30, you can simply say the stock went up. But when we buy currencies and the exchange rate moves, which one went up? Sometimes an exchange rate going up is actually a depreciating of the rate, whereas it going down might be an appreciating of the rate, depending on which way you want to read this. So the euro.us is the same as US over euro. Here's our base. There's our base in the basement, right? These two here, there's our price. So let's say at time t1, we observe a rate of 1.095. And then at t2, we observe a rate of 1.09. What can we say? Which one got stronger? Here's the euro US. So if we look at time period 1, 1 euro bought 109.5 US. If we look at time period 2, 1 euro bought 109 US. It bought fewer US dollars. So in this situation here, the exchange rate went down. That means our price currency is appreciating, or we could easily say that the euro has depreciated. They mean the same thing. So when we look at this exchange rate, 1 euro was buying 109.5 US. Now 1 euro is only buying 109 US. We're buying fewer US dollars with our euro. So we can say the euro has depreciated against the US dollar, or we could say the US dollar has appreciated against the euro. They mean the same thing. All right, let's move on to distinguish between nominal and real exchange rates. We'll start with nominal because that's really easy. Nominal exchange rate is the rate you see. Much like nominal interest rates, that's the rate you see. And what do you think we do to nominal rates to get a real rate? Well, we'll adjust it for inflation, right? You'd be correct. But there are two countries involved, which means there are two inflation rates. Just a little peek ahead. But getting from a nominal exchange rate to a real exchange rate means we're going to do something with the nominal price that we see with respect to the inflation rates in both countries, right? So let's deal with this nominal rate we see. We call it a spot rate. And the spot rate is the rate at which these two currencies are able to be exchanged for at that point in time. So euro.us is expressed in the ratio convention, USD over euro. We can look up a spot rate. That is a nominal exchange rate. So we're going to denote a nominal exchange rate from here on in with a capital letter S to mean spot rate. And you'll notice here, for the subnotation, I have D over F, domestic over foreign. When a spot rate is expressed in this format, domestic over foreign, we say that this is a direct exchange rate. When it's expressed as S, F over D, we will call this an indirect exchange rate. So what does it mean? It means nothing. It's just a convention. It's just be aware that if we're talking about a direct exchange rate, the base currency is the foreign currency. When we're talking about an indirect exchange rate, the base currency is the domestic currency. That may sound fairly straightforward, but again, it's really just a convention. It's just a way that we express a currency because we're going to do some math later on, and it matters. So by having some way that's not arbitrary, the math will work out. But let me just show you that this spot exchange rate, D over F, is not as simple as what you think it would be, and why most of the time you can just ignore that convention. Let's say that I'm in I live in Canada. I'm sure you all know that. I live in Canada, and let's say that I'm interested in the US dollar. Let's see if we can't label these domestic and foreign. Which would be my domestic currency? I don't think it would take much to say, well, you live in Canada, that's your domestic currency. You live in the US, there's your foreign currency. Anybody in grade 2 can solve that. Excellent. That's exactly right. So what would be a direct quote? Well, if it's in the form D over F, a direct quote would be CAD over USD, or the USD.CAD. There's my direct quote. Great. Let's move. I'll stay in Canada. Let's not move. Let's just move my interests around. Now I'm interested in the US dollar, and I'm interested in the Mexican peso. Which one's the foreign currency? Now, if you take a minute and think about that, you'll come back with an answer of, yeah, that's right. You're in Canada. So the US dollar is the foreign currency. And somebody may say, but he's in Canada. The Mexican peso is the foreign currency. In fact, they're both foreign currencies. So now express it in a direct exchange rate. Well, you would have F over F. What you assign to be the domestic currency and what you assign to be the foreign currency, from your point of view, could be completely arbitrary. Now, there is a reason why you'd want one as the domestic and one as the foreign. When we trade currencies, we trade the first of the pair. We make our bet on the first, but we get paid in the second currency. So if I'm trading the euro.us, all my gains and losses will accrue in US dollars. So if I'm trading the US and the Mexican, I would first say, how do I want to be paid? In US dollars or in Mexican pesos? And if I want to be traded in US dollars, the Mexican peso will be the base, which will be the foreign currency. The US will be the domestic currency. If I want to be paid in pesos, it's the other way around. So this and this are just as popular. So when we look at direct quotes and indirect quotes, there's nothing insignificant or nothing less significant about an indirect quote versus a direct quote. I want to get that out of the way now. All right, so let's continue on here. Let's set up something here, because we're going to introduce something called purchasing power parity, which really doesn't work, but it's used later on in some theories. So let's introduce what this thing means. And of course, it's economics, so we need to assume a whole bunch of the real world away. So let's assume A, a world of homogeneous goods and services. B, no market frictions. And C, no trade barriers. That means no capital restrictions. This is a world without a Donald Trump, if you can imagine that. That'll be a world without a Donald Trump. We have to assume him away now for our economic model to work. So, if an iPad cost £500 or $750, we would expect the exchange rate to be 1.5. Remember, the base is 1. So £1 would buy 150 US. So if we have £500, at this exchange rate, we would have 750 US. This sum of money and this sum of money have the same purchasing power, one iPad. So this exchange rate is called a purchasing power parity exchange rate, because at that rate, there's parity among purchasing power between the two countries. Now, let's express this as a theory. And this purchasing power parity holds in this theory for all goods or baskets of goods. But these assumptions rarely satisfied, if ever. There's some reality check here. Nominal exchange rates exhibit persistent deviations from purchasing power parity. So when you get to level 2, there's a lot more about currencies there. We start to ask the question is there something in purchasing power parity that can tell us whether a currency is overvalued or undervalued? Well, if they exhibit persistent deviations from purchasing power parity, maybe not. But we'll see more of that at level 2. It's important to introduce that to you now, that there is some theory out there between how how exchange rates are determined. And one of those theories is the idea of purchasing power parity, that exchange rates will find the rate at which there is no more ability to arbitrage goods. Let me explain that. Let's say this rate was 1.6, not 1.5. A British pound could buy 160 US. Well, 500 pounds would now buy $800. I'd take the $800, spend $750 on an iPad, and I'd walk away with $50. Why spend $500 on an iPad when I can exchange that $500, get the same iPad and $50? That's called goods arbitrage. And for goods arbitrage to work, you need frictionless markets and no trade barriers. But clearly, those things do exist, so it doesn't really work, which means there's nothing really, the arbitrage argument is nothing really forcing this exchange rate to exhibit this characteristic. Let's look at real exchange rates. And real exchange rates, you can't see them. You're never going to look somewhere and say, well, there's the nominal exchange rate, there's the spot rate. Where do I look to find the real exchange rate? You have to construct it yourself. So most places don't even bother, because even if you did construct it, well, you can't buy at that exchange rate. You either want or don't want the currency at the nominal exchange rate. But there is some benefit to looking at the real exchange rate. But this takes us, we got to sort of get two things straight in our mind. So let's take a small example. Let's say that you live in A land. This is country A, this is country B. We'll call this A land, we'll call this B land. So you live in A land, and you want to buy from B land. So you're buying some stuff from B land. What would change your cost of buying from B land? What would change your cost? Well, there are two things that would make buying from B land more or less expensive if the exchange rate between A and B went up. In other words, there's our base currency. There's A. So we read it this way: $1 buys so much of A. So if the exchange rate went up, you would need more of A to get 1B. That would make it more expensive in A land to buy B land dollars. So if the exchange rate goes up such that you need more A land dollars to buy the same B land dollars, whatever goods are in this country will become more expensive purely by the exchange rate. There's one way that changes the price. The other way that changes the price is, let's say the exchange rate stays constant, but there's inflation in this country so that the price level in this country keeps going up, the price level in this country is flat, and the exchange rate is flat, if inflation here is going up, well, you got to keep paying the higher and higher prices. So imagine that you have inflation in B land and the exchange rate is going up at the same time. It becomes even more and more expensive for an A-lander to buy B-lander goods. The A-lander will suffer a loss of purchasing power in terms of B-land goods and services, because the same amount of money will buy fewer and fewer products. Your purchasing power will decrease in terms of B-land's goods and services. Okay, we get that, right? But let's not forget about A-land. We've already talked about the exchange rate between them. We've talked about inflation. Well, A-land can have inflation. If the CPI in A-land is increasing, in other words, if inflation is increasing, and I've written this in pink, listen up, this is an important point, and incomes and CPI move together. You can't just have the price level going up to get to the conclusion we're about to get to. If the price level is going up, we must also assume that it's bringing incomes along, so that incomes are rising at the rate of inflation. That's not always true, especially for the lower income brackets. The bottom 70% really don't get that effect. They actually get hurt by inflation, but we'll assume this right now. So if the inflation rate in A-land is going up and incomes move along, and we have a flat exchange rate and a flat inflation rate here, A-land will have increased purchasing power because their incomes will rise with the inflation rate here, traded at a constant exchange rate and buying at constant inflation here. A-lander will gain purchasing power in terms of B-land's goods and services. So let's bring all three together now. Let's figure out what happens to purchasing power in terms of the CPI in A-land, the CPI in B-land, and the exchange rate. Is there a way to capture all three variables at one time? Yes, there is. Let's lead into this, and this is what we're going for down here, but I want you to see it intuitively, right? The foreign price level in domestic currency. So let's price out a basket of goods here that are subject to inflation in terms of dollars here. Well, the first thing we need to do is convert our dollars into B-land dollars. There's the exchange rate. And then we'll multiply it by whatever the rate of inflation is in this country. So we'll take a dollar, we'll exchange it for here, and then we'll multiply that by whatever the price level is to figure out what this is going to cost. So there we go. There's the foreign price level in the domestic currency, the spot rate times the CPI in B-land. And if CPI sub A is the price level in A-land, the real exchange rate is the nominal spot rate multiplied by the ratio of their two price indices, CPI in B-land divided by CPI in A-land. That's how we get to a real exchange rate. So that the real exchange rate takes into consideration the inflation rates in the two countries. That's all it's doing. Notice that if we take this term out, what is this? That's the nominal exchange rate. So all we're doing, remember when we adjust for inflation, when we go from a nominal interest rate to a real interest rate, what are we doing? We're controlling for inflation. Well, here's the exchange rate. We got to control for inflation. But remember, currencies are traded in pairs, so we need a pair of inflation rates. But look at what's going on here. A over B, B over A. Let's not forget that. A over B, B over A. The base currency, which is in the denominator here, is in the numerator over here. A over B, and you just flip it, B over A. And all we're doing is we're taking the spot and multiplying it by the ratio of the two CPIs. I think that's fairly straightforward, right? Right, let's walk through an example of this in action. Let's say we have British pounds here and euros over here. Let's say we're in Great Britain and we want to buy goods and services somewhere in the Eurozone that requires us to have euros. And we know that the real exchange rate between these two countries is the spot rate multiplied by the ratio of their CPIs. Notice it's a pound over euro, but euro over pound. So they're just flipped around when we multiply by the ratio of the inflation rates. So let's make sure we understand what we're saying here. All right, which is the base currency? The euro is the base currency, which is the price currency. The Great British pound is the price currency. If we think about it in terms of this, which is the domestic currency, the Great British Pound, which is the foreign currency, the euro. Because we're saying somebody here wants to buy goods and services here. So clearly this must be our domestic currency, and we want to buy foreign goods over here. So as long as we can understand what's going on. Let's say the exchange rate went up 10%. The exchange rate went up 10%. The Euro zone CPI, or whatever region in the Euro we're buying from, is up 5%, and British CPI is up 2%. What is the change in the real exchange rate under this situation? So we're not going from a nominal exchange rate looking for a real exchange rate. We're saying, given these conditions, what would be the change in the real exchange rate? And it is 1 plus the percentage change in the spot rate multiplied by 1 plus the percentage change in the CPI rate for the euro over 1 plus the percentage change in the CPI rate for Great Britain minus 1. Take the ones out. All we're doing is doing this. We're saying 1 plus the change in this multiplied by 1 plus the change in this and 1 plus the change in this. So we're just looking for rates of change. So we've done nothing but here's the same formula, or the same terms. We've just expressed it all in rates of change and added 1. We'll subtract the 1 after. So what did we say? The exchange rate went up 10%. So the percentage change in the spot rate is 10%. So it's 1.1 times CPI in the euro went up 5%. 1 plus the percentage change, 1.05 over 1.02 equals 13.32. So the real exchange rate increased by 13.23%. Now, there's a shortcut way of doing it. I don't like the shortcut, but it's just saying, forget about doing all of this. Just say, okay, this is up 10%, that's up 5%, that's on this side of the equation. So we're standing here. First of all, we have a 10% increase here and a 5% increase here, so that's 15% higher, but we're 2% higher, so 15 minus 2, and you can get to 13%, 13.23, whichever way you like. I don't like the shortcut way just because it leaves out some precision. Therefore, the real exchange rate is 13.23% higher. What does that mean? Well, let's go back to our spot rate. What's our spot rate saying? It is saying that 1 euro buys so many British pounds. Well, if the exchange rate is 13.23% higher, what is that saying? It is saying that the euro now buys more pounds. The euro is buying 13.23% more British pounds. It is also saying this: you need 13.23% more British pounds to buy the same goods and services in euros. So the real exchange rate increased by 13.23%. You need that many more domestic units of your currency to buy the same basket of goods. Okay, let's take another example, make sure we know what we're doing here. Let's look at this situation here. Where we are in China. Our currency is the Chinese yuan, and we are going to buy goods and services out of the US, and we want to calculate the real exchange rate under a certain number of conditions. The the exchange rate expressed as price and base with the US dollar as the base currency is dropped 3%. So what we're saying here is that $1 US buys 3% fewer Chinese yuan. So in this case, if this exchange rate is dropping, think it through. Which currency is appreciating, which one is depreciating? We always think about it in terms of the base. If the arrow is downwards 3%, means the US dollar has depreciated. If the arrow was upwards 3%, means the US dollar appreciated. So it's basically saying that $1 US is buying 3% less of the yuan. So the US dollar has lost some ability to buy yuan, right? Expressed this way, it looks like this. So for Chinese yuan, what it's saying here is that we need 3% fewer Chinese yuan to buy $1 US. You can say it whichever way you want. So the yuan is appreciated against the US dollar, or the US dollar has depreciated against the yuan. Get it straight in your head what's going on first, right? So if that's the case, just with the exchange rate, never mind inflation rates, just with the exchange rate, a consumer in China needs 3% fewer yuan to buy the same goods and services. So for the same amount of money, they can actually buy more now. So their purchasing power has increased because of the drop in the exchange rate. Let's add some inflation rates in there. Inflation rate in the US, 1.5%. In China, 4.5%. So the real exchange rate What is the change there? Now, we're just expressing this as a percentage in change, and this is not a CPI, this is not a price level, but just the percentage increase in the CPI. So it's 1 plus the percentage change in the exchange rate multiplied by 1 plus the percentage change in the relative CPIs. And remember now, the rate is the yuan over the US. So it's the U.S. Inflation rate that becomes the numerator in the ratio of the CPIs. Minus 1 gives us negative 5.78%. We could have got there directly by saying, well, this has dropped 3%, but the U.S. prices are 1.5% higher, so that makes us 1.5% better off. But we're 4.5% higher here, so that makes us 6% better off overall. Now, this is, I got to point out, this 6%, this only works. Remember now, you have this inflation rate in China, 4.5%. This assumes that incomes follow along. If incomes are not rising by 4.5% in China, then this is not a real exchange rate. This is a hypothesized real exchange rate. So we want to make sure that we understand that idea that for it to be a real exchange rate in that sense, we are assuming that wages rise along with inflation. So anyways, it's negative 6% or negative 5.78% if you want to be precise to the decimal place. Well, what does this mean now? What does it mean? It means that if we're in China, we need 6% less of our currency to buy the same goods and services in the US dollar. So this month we can buy out of the US what we bought last month, assuming all this happened within a month. We can buy what we did last month, and it'll cost us 6% less. In other words, our currency has gotten more valuable in US dollars, or the US dollar has gotten cheaper in terms of our currency. We're saying the same thing. Let's walk through one of the examples in the reading here. This is example 1. I'm not going to repeat it word for word. You can read it. I'm going to extract the highlights here. Here's the setup. You hold bonds in Hong Kong dollars. So you have bonds that are denominated in Hong Kong dollars and the interest payments are in Hong Kong dollars, but you live in Australia. So you're concerned about the exchange rate between the Australian dollar and the Hong Kong dollar. And notice I've expressed it in the form SD over F, the domestic currency being the Australian dollar, the foreign currency being the Hong Kong dollar. And we're going to go through a number of scenarios and find out whether or not these things are true or not. So someone tells us, hey, if the exchange rate has increased, those Hong Kong bonds you have, they've also increased in terms of your Australian dollars. So in other words, even if the price of your Hong Kong bonds didn't change, you just got richer in Australian dollar terms. Do you believe that? Is that a true statement? Well, let's think about it. If this exchange rate increases, what is it saying? It's saying that 1 Hong Kong dollar buys more Australian dollars. If your bonds are all in Hong Kong dollars and this exchange rate goes up, that means those same Hong Kong dollars can buy even more Australian dollars. So this is a true statement. Yes, if the spot rate of the exchange rate, the nominal exchange rate here, increases, Hong Kong dollars buys more Australian dollars. All right, let's look at our second statement here. And the second statement was a little bit different. If the spot rate or the exchange rate increases, the relative purchasing power of your bonds, of your Hong Kong dollar bonds in Hong Kong increase. So what this is saying is that an increase in the nominal exchange rate means that the relative purchasing power for your Hong Kong denominated bonds have increased. Do you believe that? No. Hong Kong dollars buy more Australian dollars, yes, but they do not buy more goods and services denominated in Hong Kong dollars. So the exchange rate has gone up, but the purchasing power of your Hong Kong dollars tied up in those bonds in Hong Kong has not increased, because that's a different country with a different price level. So the exchange rate is only the relative price of goods and services between countries, not within a country. So no, we don't believe that. Number 3, if inflation in Australia, the CPI in Australia increases, then the real exchange rate has increased. And if the real exchange rate is increased, that implies that the relative purchasing power of Australian income is higher. Now you're probably looking at that going, oh, hang on a second, I can't work through that. Yes, you can. Let's think about it. Look at this first statement here. If inflation, if the CPI in Australia increases, then the real exchange rate increases. Well, how do we calculate the real exchange rate? We take the spot rate and we multiply it by the ratio of the two inflation rates. So the question, the statement actually from the book says, holding everything constant or all else equal, all we're saying is that the inflation rate has increased. So what happens to the real rate? Well, here's the inflation rate in Australia in the denominator. If this stays constant and this stays constant, but this increases, what happens to this ratio? If the denominator increases, this ratio gets smaller. And if this ratio gets smaller and you multiply it by a constant, the end result will be lower. So what will be the real exchange rate? This is the formula here for the real exchange rate. So if CPI in Australia goes up, the real exchange rate, holding this constant and this constant, would decrease, not increase. So this is a false statement. If the CPI increased, this ratio decreases, the real exchange rate decreases. Well, what about this second statement? Now, this second statement rests on the assumption that the real exchange rate had increased. All right, so it's saying if this happens, then this happens, and if this is the case, then this. Well, let's say that, okay, well, if the real exchange rate was higher, would number 2 be true? It implies that relative purchasing power of Australian income is higher. No. If the real exchange rate increases, the purchasing power of the Australian dollar decreases. Again, let's think about that. We can think about the exchange rate. It's the Australian over Hong Kong. Same with the real rate, Australian over Hong Kong. All this is saying is that 1 Hong Kong dollar buys so much Australian dollars. If the real exchange rate is increasing, 1 Hong Kong dollar buys even more in Australia in real terms. So the purchasing power of the Australian dollar actually decreased, because if one buys more, then you need more over here just to buy one. So it's actually decreasing. If you can remember this particular formula here and you get questions like this, it's easy just to say, you know what, I'm not going to worry about trying to think it through in my head. I'm going to look at the formula and say, well, this is a ratio. If this is increasing, then this is happening. If this is decreasing, just work it out that way. You'll find it flows a lot smoother. All right, number 4, let's look at our next statement here. If the nominal exchange rate drops, then the real exchange rate will drop and increase the relative purchasing power of Australian income. Okay, well, let's think about that. The nominal interest rate has dropped. What's going to happen to the real interest rate? Well, the real exchange rate. Well, remember, this is how we calculate the real exchange rate. It's the nominal rate multiplied by the ratio of the two CPIs. And if these do not change, and this simply drops, then this whole term drops, which is the real exchange rate. This drops. So this first statement is true. If the nominal exchange rate drops, then the real exchange rate drops. Okay, well, let's think about what's going on here. The real exchange rate has dropped, which means 1 Hong Kong dollar buys fewer Australian dollars, or to say it another way, 1 Australian dollar can buy more Hong Kong dollars. We need fewer Australian dollars to buy 1 Hong Kong, which means for the same amount of Australian, we're getting even more Hong Kong. Does the second part make sense? Increase the relative purchasing power of Australian income? It certainly does. Because given a constant income from paycheck to paycheck, if the real exchange rate is dropping, that constant paycheck buys more and more and more goods and services denoted in Hong Kong dollars. It implies the Australian dollar is strengthening against the Hong Kong dollar. That's a true statement. Number 5, the nominal exchange rate has increased 5%. CPI in Hong Kong is up 5%. CPI in Australia is up 2%. The Hong Kong bonds, if we translate them into Australian dollars now, are we getting more or are we getting less? Have they increased or decreased, and by how much? Well, the exchange rate, the nominal exchange rate is up 5%. We don't really need to know anything about the CPI. We're just saying our bonds represent so many Hong Kong dollars. Do we buy more or fewer Australian dollars with that? Again, let's read it. 1 Hong Kong dollar buys 5% more of Australian dollars. So our bonds will be worth 5% more in Australian dollars, right? What about the change in relative purchasing power of Australian income? And again, we're looking for the real exchange rate. We have a nominal exchange rate that went up, so that's good. But look at the inflation rate in Hong Kong. It went up 5%. So we can buy 5% more, but everything's 5% more expensive. But we're up 2% here as well. So let's see what happens here. It's 1 plus 0.05. That is the change in the spot rate for the real exchange rate. 1 plus 0.05 multiplied by 1.05 over 1.02. Remember, this is Australia over Hong Kong, so this is Hong Kong over Australia, 1.05 over 1.02, minus 1, multiply it out, 8.089%. So what is this saying? This is saying that the real exchange rate, remember what our Hong Kong dollars can buy, right? The real exchange rate has increased 8.089%. What is that saying? So let's draw our two circles, AUD, Hong Kong dollars. Let's see what's going on. The base is the Hong Kong and our price is Australian. So 1 Hong Kong dollar buys how much more Australian here? So we're going from here to here. Well, we're told that the rate went up 5%. So there's 5%. We're also told CPI in Hong Kong is 5%. That should drive incomes up by 5%. But the inflation rate here is 2%, so that should drive our purchasing power down by 2. 5 plus 5 is 10, minus 2 is 8. That's how we get to that. Now, if you're thinking about this for a minute, you would say, but hang on, that doesn't seem to apply to me. I'm holding bonds. They're not inflation-protected bonds, they're straight bonds. So if there's inflation rate in Hong Kong by 5%, that doesn't make my bonds and my income 5% higher. In fact, I don't benefit from that 5% at all. I benefit from the inflation rate of 5%, the exchange rate from 5%, but then I suffer from the inflation rate in Australian dollars by 2. For me, it's only a 3% real increase, not a 5%, because my income from these bonds is not tied to inflation. That is true. That's a big difference. So when we're looking at this, at going to real exchange rates, and you're talking about the value of an investment in one country versus the value of it expressed in your home dollars, you cannot make the assumption that the inflation rate in the foreign country is driving your foreign income. It's not. Only the exchange rate and the inflation rate in your own country matter, because if you own a bond that's not inflation protected, and let's say it matures at $1,000 a year from now, it does not matter what the inflation rate is in the country that you hold the bond in. It only matters what the inflation rate is in your country, because when you get that bond back in a year, if prices have gone up 2%, you've lost 2% purchasing power. You hope at least the exchange rate will have gone up by more to offset that 2%. So this conclusion, which, by the way, the book arrives at, based on this setup that you're holding bonds in Hong Kong, based on this setup, is an erroneous conclusion. The only thing that matters for you is the 3%. Now, I don't think that in an exam you're going to be offered the choice to expand upon the answers. Just answer it the way they want to answer it. But we're all people with brains that can think, and we could say, but wait a minute, that doesn't make sense in a situation like this. You'd be right. Okay, let's have a look at participants. And here we'll break it down into two broad groups, the buy side and the sell side. And we'll start with the buy side. We have 6 listed here. Corporate accounts. Businesses, well, they buy and sell, and sometimes they buy products from other countries. They import, and sometimes they export. And especially for global companies that have a presence in multiple countries and do business in multiple currencies. Revenues and expenses can occur in a foreign currency. They can borrow in a foreign currency. Corporate accounts primarily use the Forex market for hedging. They're not there to speculate. Next, we have real money accounts, institutional funds like pensions, endowments, etc. Hedging of or unhedged foreign currency positions, limited active trading. Now they can use currency as an asset class, but it's very, very limited. Usually in their IPS, they'll have a policy about how they deal with foreign currencies. Either they don't hedge the foreign currency, which means if it's a US-based account and it wants to buy, let's say, Canadian securities, it would then have to buy some Canadian currency first before it buys the security, so it's active in the Forex market in that sense. If it hedges, it would still have to buy some Canadian dollars to buy those securities and then enter into a forward contract to hedge out that exposure. When we say limited active trading, they may have an unhedged position of which they would hedge a portion of that position only, thereby leaving some exposure to the currency. Leveraged accounts, hedge funds, proprietary trading desks, and so on. Forex is an asset class. In other words, they treat it like they would treat a stock or a commodity, is they think, well, this currency is going to appreciate against my currency, so I'll take a position in that currency. So they do have active trading. Retail accounts, these are non-professional people like you and me just sitting at home. Typically spot market transactions. Retail doesn't use the forward market at all. I shouldn't say at all, but very rare do they step into the forward market. They're typically active in the spot market. Governments will be in the currency market to take care of transactional business because, of course, governments also import and export things. And they'll use the currency to set policy goals as well. Central banks, they do intervene in the currency to target a certain, if it's the currency's too strong or too weak, they'll target a specific currency value. And central banks have foreign currency reserves. So every now and then they build up, or a particular currency will build up to be too much. Then they have to sell that currency and buy their own currency. One more on the buy side, sovereign wealth funds. Countries with large current account surpluses and will typically put that money into a fund, which is why it's called a sovereign wealth fund. And they'll manage that fund to some mandate, whatever it happens to be. You'll revisit sovereign wealth funds at level 3. When it comes to currency exposure, their investment mandate can run from hedging to some active positions, but they certainly don't treat Forex as an asset class. The sell side, and this is really easy, it's the dealing banks, the Forex dealing banks. These are the largest first-tier global banks that set up the interbank currency market. So we've been through a bunch of different participants, and we've seen that they use them all for different reasons. So this is important here. Given the wide variety of participants and motives, it is difficult to predict movements in Forex rates. Of all the markets that I've had exposure to, predicting a move in a currency is difficult. It is notoriously the most difficult prices to predict. Market composition in terms of where the weight of the transactions are in the spot market. About 33% of the volume happens there. In the forward and futures market, this is used for speculation, but primarily for hedging. Spot market is used for transactions and speculation. You get 14% there. And the reading, I think, makes a bit of a confusing mistake. They refer to FX swaps. But then in referring to FX swaps, they give the description of a currency swap. An FX swap is a very particular thing. It is being long a forward contract, and on expiration, you don't want to honor the forward contract. You want to roll it forward. While you have a spot market transaction along with rolling the forward over, that's called an FX swap. It combines a spot and a forward transaction. For a swap, the way the reading describes it, that is a currency swap, which means that you have a company in one country, a company in another country. Let's say this is in US dollars here, they're in euros here, and the US company wants euros and the euro company wants US, so they will swap currencies and then they will pay each other's interest rate, and then at the end of the period they will swap the currencies back. So the legs here could be fixed for fixed. In other words, I'll pay you a fixed interest rate and you pay me a fixed interest rate, or it could be floating for floating. You'll see more currency swaps at level 2, and then you'll see them applied slightly at level 3. Largest proportion of Forex trading occurs in London, followed by New York. So the Forex markets, especially the spot market, is the most active between 8 a.m. and 11:30 because that is